Good morning, everyone, and thank you for joining us on Morning Markets. Before looking at how asset markets performed last week, a little bit of a plug for our Do More With Your Money show, where you can get that live on the YouTube channel at this point in time, talking about retirement and your saving options in retirement as well. So please do head along to the YouTube channel and take a look at the Do More With Your Money show. Looking at asset markets then last week, we had a better performance from equity markets over the course of the week. Major markets up around 2 to 3%. That does mask a little bit of a down day on Friday, but nonetheless, a better performance over the course of the week for equity markets. And really it was a very important, momentous week for a number of factors. Last week we had the European Central Bank increasing interest rates for the first time in more than 10 years. We saw the challenges laid bare that they will face as they change policy direction, exacerbated by the political situation in Italy as well. And we continue to hear from companies reporting their results for the second quarter and their outlook for the rest of the year. And again, really that brought to life those number of competing forces that we've been discussing that are influencing market direction, that of interest rates, inflation, and how economic growth is evolving. I think on Friday, the economic headwinds were very clear and evident in terms of a number of purchasing managers' indices in both the Eurozone and also in the US, really highlighting a deterioration in sentiment. And that deterioration was not just in manufacturing, but also it had moved into services as well. And that's certainly something that we will be continuing to watch over the coming months as well. And that really just brought about that ongoing level of volatility in sovereign bond markets in particular. The US 10-year yield back into around 275, coming in around 30 basis points over the course of Thursday and Friday. So that theme of volatility in markets, in sovereign bond markets, very evident as well. And that neatly brings us on to the week ahead, and we have the US Federal Reserve, so the central bank in the US, giving us their monetary policy decision. Cast our mind back only a few weeks ago, there was a near 90% probability that we would see rates increase by 1%. That's certainly fallen back, so the consensus is that we will see US interest rates increased 0.75% on Wednesday. So looking out for that. We also have US GDP, second quarter GDP, coming out this week as well. And that could present a really interesting conundrum for a number of people, in that we may have a second quarter of negative GDP readings from the US. A very sort of naive definition of a recession would be 2 consecutive quarters of negative GDP growth. But clearly we've got a background of very strong employment as well in the US. So that one factor may force the NBR not to call for a recession, just in that very narrow definition. We'll leave it there for today, but please do join us through the rest of the week. Many thanks. If you're interested in taking your investing to the next level, or would like to know more about the options available to you when you retire, then download our free guides to ISAs and pensions. These are available in the video description below.